Hi, I'm Ross O'Brien with the Economist Corporate Network here in Hong Kong. We've just wrapped up our Q3 regional strategic forecast. I'm joined by Leo Abruzzese, who is our global forecaster with the Economist Intelligence Unit. Leo, thanks for coming this morning.
Ross, thank you for the invitation.
You started us off this morning with your 3 R's: risk, recovery, rebalancing. This is your synopsis of the outlook into the final parts of 2013 and into 2014.
Yes.
We've obviously seen in Asia in particular a good deal of that first R, the risk and the perceived risk of emerging markets that's caused stock markets to tank a little bit, and some currencies, the rupee most perniciously of all, drop I think 20% today.
Yes.
This is an overreaction, market overreaction in your estimation. How big is the risk?
I think there is a market overreaction. Markets overshoot all the time. Remember, the Fed has had a consistent, very loose policy for 5 years.
Yeah.
And whenever you're at one of these turning points, markets overshoot. I think it's interesting to note that with the possible exception of India, which really has some weaknesses, a lot of that damage was done in June and July and has actually stabilized a bit.
Mm-hmm.
So there's no question. Is capital flowing out of emerging markets? Yes, but some more than others. I would describe this as a volatile period during a transitional phase, not a catastrophic period. I think we'll see a bit more volatility. I do not think we are going to see a disaster. This is not 1997 and 98 and the return of the Asia crisis.
Right. Now, the countries that have been most badly affected thus far include India, and to a lesser extent, but still fairly badly, Indonesia. Do you think that this, whether it's a reaction or an overreaction, has it exposed some weaknesses in these economies, in the structure of these economies? Does it make India a bad bet?
There's no question that it has exposed some weaknesses. When you have a flood of liquidity of the kind we had before, when investors are not going to be investing in the US or Japan or Europe, as they have tended not to do, and they flood into emerging markets, that old argument about liquidity hiding a lot of sins, it certainly did hide those.
Right.
The liquidity has receded, the sins have become a bit more obvious. So yes, Indonesia has not been very friendly to foreign investors. They've put in taxes, they've put in policies that have been quite detrimental to the investment community. India has had deficits for years. I think all of us, and probably including some of us at EIU, had blinders on there for a little while and didn't see some of the issues. Does it make India a medium-term investment pariah? Absolutely not. But it does mean that until India takes a few of these reform measures, if they take them, by the way, India has had a 20-year history of moving ahead and then moving back a bit. So India needs now some perseverance, some consistency, and some commitment. If it can manage that, India's back on track.
Right.
But I do think we might be 12 to 24 months from seeing that, because there's an election coming, and you know what happens when elections come.
That's right. You intend to spend $19 billion on a food subsidy program to perhaps make people vote a certain way.
Shocking, isn't it?
Your second R is recovery, and as you pointed out, which I hadn't realized until this morning, all the 3 big advanced economies are now, for the first time in, what, 2 years, all growing positive?
Yeah, almost really in 3 years.
Okay,
That's
wow.
right. Because we had the recession in 08 and 09. They all bounced back a bit in 2010. But then Japan, of course, had the tragedy in 2011.
Mm-hmm.
Then Europe went back into a recession, and the U.S. has done generally better. But this is the first time that those 3 big engines all grew, and that's mainly because Europe grew in the second quarter.
Right.
Europe had a 6-quarter losing streak, but Europe now has its head above water, barely above water, but
right.
above water. But the U.S. grew 2.5% in the second quarter. Japan is growing at an even faster rate than that. So pretty good news. I mean, you have there about $40 trillion worth of global GDP.
Yes.
It's actually all in plus territory. So that's good for them, and of course, good for Asian economies, because after all, Asian economies are selling quite a bit to these economies.
So this is kind of underpinning your view that 2014, globally and for all the regions you've just mentioned, will see better GDP performance than this year.
Yes, that is. Again, I want to be cautious. We're being moderately optimistic about this. This is not a boom time by any means at all. If it was, the U.S. would be growing by 3.5 or 4, not barely 2.5, and Europe would be growing by more than 0.7 or 0.8. So it's hard to get excited by 0.7. But yes, it does underpin our argument. If you look at the global aggregate growth, add everything up together, we do expect the global economy to grow by about a 0.5 percentage point, maybe a bit more, better in 2014 than 2013.
Now, onto your third R, this rebalancing. When we, in Hong Kong particularly, think of rebalancing, we tend to have China on the brains. We think about China's slow, inexorable shifting of its economy away from capital investment and exports towards domestic consumption, which slowly creeps up a percentage point a year. But that's not the entirety of what you're talking about when you're considering rebalancing.
No, that is a portion of it. There's no question about that. But it also applies to other countries as well. So you have a country like Brazil, which we don't talk about very much in Asia, but a powerful economy too. But here's also an economy that, unlike China, has never invested very much.
Right.
So this is an economy that has to rebalance in favor of investment.
Okay.
China needs to rebalance a bit away from investment and towards private consumption, a bit more consumer spending. So we want consumers to hold up a bit more of the sky in China than businesses have too. So it's really a rebalancing or an evolution. Certainly the growth rates, those percentage numbers, are not going to be as big as they were before, but hopefully they will be a bit more sustainable. As we pointed out, China was growing at 14% a few years ago, and now it's 7%. Is that a disaster? Well, 7% on an $11 trillion base gives you more added economic activity than 14% on a much smaller base. So it is a stabilization, it is a rebalancing, it is a reshifting. Certainly the emerging markets are in a new phase. This is not 2006, but it's also not the death of emerging markets. I think that has been considerably overdone.
That's right. And of the world's emerging markets, Asia has perhaps still the greatest collection of reasonably stable growers.
No question. If you're looking for a new area, always good to keep an idea on Africa, because there are some fast-growing economies there. But Africa is still a few decades behind Asia in terms of sophistication, size of the economies as well. So Asia is still the principal game in town.
Great. Well, it's a good place to leave it. Leo, thanks very much for your time.
Ross, thank you very much as well.
I'm Ross O'Brien with the Economist Corporate Network in Hong Kong. You've been watching our wrap-up of the Regional Strategic Forecast, just concluded here in the Conrad Hotel. Thanks for watching.